There we go. You may have to click a button to get out of that thing, and it's showing up in the way there. So I used to be a corporate controller in multiple Fortune 500 companies, which means I managed money, right? And it was high-tech manufacturing. So there was a lot of machines, and my job was to keep the costs down. And we had very, very high-tech, cutting-edge stuff. And we saved tens of millions of dollars. This is $1 billion company, right? And luckily I had smart people working for me, because I would never be able to figure it out. But but the irony is, not to brag about that, but the irony is I didn't know how mortgage interest was calculated. I didn't understand, they're kind of front end loaded. It's a closed end amortized loan. And if you have a 4.5% mortgage, which is what I have now, you're paying more than 4.5%. And I don't know if you know that or not, but I didn't. And I don't think most people outside of mortgage industry knows that. So it was a real punch in the gut when I took an early retirement 3 years ago. And I had refinanced the house I'm in 3 times, Rosalind, okay? I've been living here 25 years. And every time I refinanced, I was looking to do one thing, I'm sure you know what that is. You guys are experts. Edith, what was I looking to do? Come on, tell me.
Save money.
Save money, and be more specific.
Lower that rate.
Yeah, lower that payment.
Lower the payment so I would have more cash flow every month. Lower the payment, right? And so I didn't look at the whole picture, though, because you start the whole mortgage clock all over again. And you got closing costs and stuff like that. And anyway, so I took an early retirement, and now I'm looking at this mortgage from a different angle that I wasn't looking at it before. So now it's more than just lowering the cost. It's, when am I going to friggin' pay this sucker off? And I'm 64 now, and I was horrified to learn that I wasn't going to pay it off until I'm 80. And I've already been living here 25 years. And that was like the low point of my career, So anyway, very embarrassing. It was a hard conversation from my wife. And so I met a guy on LinkedIn who showed me this program, which we're going to go over with you. And it's been a lifesaver for me. I'm going to reduce my debt time from 30 years to 7. And I'm going to save $110,000 of interest without changing my lifestyle or my budget or my cash flow. So it's only using discretionary income. So I don't have to sell my car and ride a bicycle and stuff like that. So this program has won several awards. We're going to talk about it, but it's like I feel like I have the cure for cancer, and I'm on a campaign to share the message, with as many people as possible to level the playing field. And so there's one thing I want you guys to think about, since you are in the mortgage industry. The overriding principle here, I should have had this open. Sorry, here, hang on. I want to show you not just how to eliminate debt, but more importantly, how you can get more business. The overriding purpose of this call is to show you how to get more business in the mortgage industry, okay? So where is my, hang on, I should have had this open. All right, here we go. So tell me, I'm going to share my screen going forward here. Hopefully you can see my screen. And any minute now, this is going to happen. There we go. All right. Now this is a real estate agent. We have a real estate agent who's using this marketing piece. Now, I know you guys are in the mortgage industry, but I want you to put your antenna up. I do more than help my clients find their dream home. I show them how to pay it off in as little as 5 to 7 years. So imagine if you could have that conversation, not only with the current prospects you have, but every client you've ever worked with. You would be the hero to all of them. And imagine the referrals you're going to get when you are the mortgage person that showed them how to pay off a mortgage fast, and you can get commissions for doing this. This is what Alexita and Kathy and Eric and I are all doing. Okay, so I want you to keep this in mind as we proceed here. So I'm going to share with you a little bit about this program. I know Rosalind knows a little bit. Let me bring this down here. But my goal here is to show you how to get more business as a mortgage officer. All right, 2 more clicks and we'll get going here. Come on. All right, down to 1 more click. And here we go. Can everybody see that? Can somebody unmute and say you can see that? Anybody?
I see it.
Okay, cool. All right.
Yep.
By the way, I didn't say hi to Sol. Is Sol still on? I'm sorry, I was talking. Anyway, welcome, Sol. All right. The company's name is United Financial Freedom. You've never heard of them. They're out of Utah, but they don't do any marketing. They're a privately held business. And the program they have is called the Money Max account. And what we're going to show you is how we can revolutionize your business for any of these professions, not just mortgages, but you work with real estate agents as well. There is a opportunity here to have an agency type model. Okay, so where you can get the benefit of people on your team. So imagine yourself and your team asking people one simple question. If there was a program to eliminate most of the interest in your life and pay off all your debts, even a mortgage, in as little as 5 to 7 years, without refinancing, without changing your lifestyle, would you want to learn more? So this works for all debt, not just mortgages. It just happens that mortgages are the biggest debt most people have, and also mortgages have the most interest most people pay because of the way interest is calculated on an amortized loan. So if there was a way to pay off all your debts, would you want to learn more? And the answer for most people would be yes. All right. So why should you pay attention to this? These slides are about 4 months old, so I'm going to blow through these pretty quick. But you know, the real estate industry and inflation and debt has all been on a roller coaster ride, you know, this year, as you guys know more than anybody else. So these are a bunch of slides that talk about, you know, some of the challenges that are in the mortgage industry, the real estate industry, etc. Rosalind says things are going fast, so I'm glad to see you guys are doing okay. But I know a lot of mortgage people who are stressed out right now. The fact that they're having a 40-year loan modification is kind of telling. The mortgage rates are going up. You guys know that. They've come down a little bit recently. And then, of course, we got inflation. Okay, everything's going up in cost, from food to gas. This is not big news. Now, luckily, gas has come down a little bit from this. I'm going to blow through the rest of these. Basically, these are all headlines that I put this together back in April. And things have gotten a little bit better, but the point is that people are stressed out. They need help. And I'm going to show you how you can help them. And by doing so, you're going to become the hero to your clients, your prospects. And I hope you can envision all the massive amount of business you're going to get. Because here's the thing, if somebody's life is a book, if there was the biography of Rosalind and it was 500 pages, the amount of time Rosalind is going to be looking to buy or sell a home is probably 3 or 4 paragraphs, maybe, out of a 500-page book. But the amount of time that she's in debt could be half the book. So the point of that little analogy is there's a big opportunity here to get your foot in the door, to talk to somebody, and you know, ultimately become a mortgage client, but also help them pay off their debt. You can get paid for doing this, and it's going to increase your business as well. So the solution is debt freedom. I'm going to show you how we pay off all our debt in as little as 1/3 the time, without changing your budget, without consolidating debt, no refinancing, with an impeccable cash flow program. There's no magic, it's just math. I need to share a little bit of the history because the two guys who founded the company used to be mortgage officers. They had their own company in Utah. It was one of the fastest growing companies in Utah. And they kept seeing the same people refinancing over and over and getting further and further in debt. And they weren't using refinancing strategically like it was meant to do. They were using refinancing to go out and buy more boats and motorcycles and stuff. And they decided to change their entire company's focus from mortgages to helping people get out of debt. They hired a team of NASA scientists and math PhDs, and they created this software program that's 35 pages of banking algorithms. And in 2004, they launched it. So they completely changed their company now into a debt elimination company. And they launched it in Denver. They had a beta test of about 300 clients. And after a year and a half, 95% of the people were still using it, which told them, it works and it's easy to use. And 70% of them were getting at least 20% better results than they had thought they were going to get. So the program works, it's easy to use. And after that beta test, they decided to go full blast with this. And now we're on version 5.7. So it's a pretty great story. This is something that's pretty important to me. I don't know if anyone's ever heard of Ernst & Young. They're a massive global accounting firm, and they're very conservative because they're accountants. We won an award from them in 2008 after they spent a significant amount of time doing due diligence on our financials, our longevity, retention, the product viability, impact on consumers. They interviewed every customer we had. And based on all that, we won this award from them, which was a big deal for me being in the finance company and the finance industry. They wouldn't put their name on it unless 98 accountants had checked the math. Ernst & Young has also given the same award to Apple, Starbucks, eBay, and Microsoft. So pretty big deal here. I know you've never heard of the company. I like to bring this up because this gives it some credibility. We've been in a whole bunch of magazines, a lot of them focused on real estate, including Mortgage Planner, Success from Home, True Wealth, personal real estate investing, et cetera, et cetera. These are right up your alley, being in the mortgage industry. So this is a great fit. We've had over 80,000 clients now. This is a couple months old, and we're up to $2.3 billion of debt that we've eliminated for our clients. So it uses what we call a GPS technology, like a GPS. A GPS will tell you how to get to wherever you're going as fast as possible, and it recalculates when you miss a turn or when there's a construction or the bridge is out or there's heavy traffic, it will recalculate. Well, our program does the same thing, only financially. It shows you in real time the exact path to become completely debt-free and save as much money as mathematically possible. It's using banking algorithms just like a bank. Okay, it's the only program that uses technology to give you the exact pathway to becoming 100% debt-free. And it doesn't require any changes to your lifestyle or refinancing any loans. Now here's the key slide for you guys. Now, I'm recording this, so you guys are all going to get this. But think about what this can do for you in the mortgage industry. It's going to help you stand out as an industry leader. Imagine the branding this is going to give you. You're really going to be able to differentiate yourself from every mortgage. I know you probably have a lot of cool things going on based on what Rosalind said. If you guys are still, cranking business, that's a pretty good sign. But imagine how much more branding you could get out of this. It would give you a massive competitive advantage. You'd become a trusted advisor, not only with your clients, but with your partners. You get a lot of repeat clients. You get a lot more referrals. This is a completely unique value-added proposition for your clients. I mean, how many other mortgage offices are offering their clients how to pay off the mortgage and other debts? That's pretty cool. I mean, if my mortgage officer would have showed me this, I would be, constantly referring people to them. It's been 25 years now. It'll forge stronger relationships with your partners. It ensures your clients continue to build equity even in a down market. They can upgrade their homes faster. And what does that mean? That means they can purchase more properties. And a real important point that people overlook is this is an exit strategy for your business. In other words, this is another stream of income that you could have, and you could do it without losing focus of what you're already doing. We don't want to have you learn a whole bunch of new stuff. We just want you to give you another arrow in your quiver of what you're already doing to help your clients even more and to help yourself more as well. It also works for insurance and CPAs. We're going to skip through that. So this is the picture I showed you. Here's an example. This is what a realtor is doing right now. You're becoming the realtor known not only as an expert in housing, but also showing clients how to build equity fast and how to eliminate their mortgage in 5 to 7 years. They're going to stay top of mind. When a client is using this program, there's zero marketing cost, but they're going to be thinking of you every day. Every time they log in, it's like free marketing. And it's going to increase the number of transactions you're going to see. Because once they start building up generational cash flow and wealth, they're going to be able to add rental properties and second homes to their portfolio. So there's a lot of advantages here built into this. If you can imagine helping people pay off their mortgage, pay off their other debt, one of the big benefits of this is their credit scores improve as well. Okay, and it will give you an exit strategy. I mean, no job is safe. We just looked at some of those headlines. There were a lot of people got laid off when the mortgage rates went up. Hopefully not too many people from your company. But you never know what's going to happen. I've been laid off 3 times from 3 different corporate jobs. And it's never been fun. It was never expected. And it was never anything I did wrong. It's just the way the economics worked out. So it's always good to have another stream of income to help you reach your goals. So why now? Have you ever wanted to help your prospects with your services, but monthly debt payments got in their way? They didn't have enough to get a mortgage. It would be great if you could help them put a financial plan in place if there was no way to do so. And the problem is usually debt, and will continue to be debt, particularly with interest rates going up. People are getting more and more into debt. And this is all debts. So you can become the trusted source and change their life. And it's a great feeling. Now, I think you guys know this. This slide is designed for non-mortgage people, but on a 3% mortgage for $370,000, this was sort of the national average about a year ago. And, this has all changed pretty fast. But anyway, using this example, you know that the interest rate is 3%. But the interest volume you're paying, in other words, on a $1,500 payment, you're paying this first month, that's actually 60% of the payment you're making is going to interest. Now, you probably already knew that, but just in case you didn't. And after 6 months, if you add all this up, that's really 59% of the total payments you've made are interest. So they're not reducing the balance whatsoever. There's a massive opportunity cost. You're not going to be able to, if you have this mortgage, you're not going to be able to do anything with this $5,000. It's gone for good once you pay it. And so people are sometimes being misled. This is not your fault. It's just the way the mortgage is calculated. They're thinking, I'm really only paying 3%. Well, this is the way this interest is calculated. They're paying a lot more. It's interest rate versus interest volume. So here's another way to look at it. 60% interest the first month. On a 30-year loan, you only hit the halfway mark of the mortgage after year 19. That's because there's a lot of interest at the beginning of the mortgage. So it's not a smooth, flat rate. It's heavy on the interest at the beginning. So anybody who's refinancing, is starting the clock over with the heavy interest payments at the beginning. And on this particular mortgage, if you paid it all off in 30 years, which most people don't, they either refinance or move. But if you did, you'd be paying $191,000 of interest, which overall works out to be 34%. So that's kind of brutal. And you guys know about the truth in lending statement, I'm sure, where you're obligated to show the client what the total interest percentage is. Here's an example. They signed up for a 2.65% mortgage, but due to this truth in lending statement, they're actually going to be paying 42%. And most people don't get that when they close, or they kind of blow through it, or even if they do understand it, they really can't do much about it. But it's a lot more interest than people think. This one was a 4% loan. They're actually paying 69%. These are real client statements. Okay. So here, the fact of the matter is, when you have a mortgage, you pay a lot of interest, a lot more than you think. And the other fact is that people are getting more and more into debt, whether it's mortgages, whether it's credit cards. Credit cards debt is skyrocketing. All kinds of debt is going up. And so in order to eliminate debt fast, it's important to understand the formulas, the timing, the algorithms. Our program uses a client's entire cash flow. Every asset they have is either earning or canceling interest as fast as possible. Here's some client results we had. Mark owed $193,000. It was going to take him 26 years to pay that off if he just followed the normal amortization schedule. With our program, he paid everything off in 2.9 years and saved 73 grand. Lay paid off 32 years of debt in 9 years and saved 217. Remember, they're not changing their lifestyle at all either. This is live the way you're normally living. Invest what you're normally investing. Continue to go out to eat, do whatever you're doing. Our program is just using discretionary income. And look at these numbers. Scott's going from 39 years to less than 4 and saving 224,000 in interest. I mean, these are pretty big numbers. These are real clients. John is going from 39 years to 10, a little less than 11, saving 176. Tremendous savings in payments, in time, and interest. These are just a random sample of 5 people. My number is 110,000 savings and 23 years I'm saving. Kathy's on the line. She's down to like 3 years to pay off all her debt, and her number is very big. All right. This is an example of how our program works real quick. What are we doing for time? We're almost halfway done. I'm going to go through this very quickly, but just to show you one iota of how our program works. Now, you don't have to have a line of credit, but the fact is, every type of debt has an interest rate and terms, but the way the interest is calculated is different for each kind of debt. All right. So the question here is, would it ever be smart to take out a 10% loan to pay off a 3% debt? Anybody have a thought on that? Anybody want to unmute and say, is that possible or is that dumb? Nobody? Anybody?
I think it depends, like you said, it's the volume and the timing of it, depending on it.
Yep. It's the type of debt it's the type of loan you do, right? Watch this. Okay, this is pretty eye-opening for me, and I'm hoping I'm not going to waste your time on this. So we already looked at this mortgage, right? This is the same one we just looked at. These are the first 6 payments. Okay, $370,000 mortgage. What if we had a 10% line of credit? Okay, a line of credit is an open-ended loan that uses an average daily balance and a simple interest as opposed to an amortized interest. You don't have to know what that means. Just know that the math is different. So watch, this is pretty amazing. We're going to borrow $31.99 at 10%. The interest on a line of credit is 10% times that is going to be $320 for the year to borrow $31.99, or for the month, just divide that by 12. It's $26 a month interest to borrow $31.99. Why would we do that? Well, what we're going to do here is the first month we have this mortgage, we want to cancel out the interest. There's a unique relationship on a mortgage that every payment, the interest and principal is locked together. And the only way to pay off a mortgage faster is to pay down the principal faster. And we're going to do this without changing our lifestyle or our budget or our cash flow. So watch, this is an example of what you could do. And this is what an example of what our program does in the background. So you don't have to know this, but this is like our program in action. So what we do is we make the first payment in September, and then we'd say to the bank, I want to pay an additional $31.99 against principal. Why would I do that? That is the sum of 5 months of principal payments here, right? $31.99 equals that plus that plus that plus that plus that. So by paying that against the mortgage, we're going to cancel out all the interest that's associated with those 5 payments, which is a total of $4,600 of interest that we're canceling out, and we never have to pay it. And the cost to do that is $26. Everybody let that sink in for a second. We're paying a bank for a line of credit. We're going to use $26 of interest. We're going to borrow $31.99 and be charged $29, and we're going to cancel out these 5 payments for $26. How often would you do that? I would do that as often as possible. If I paid somebody $26 to save $4,600, I would do that all day long. So what happens here? You don't get 5 months off. You still have to make a payment in October, right? So what happens is the March payment, which you don't see here, moves up in line. And now the next payment you're going to make would have been the March payment, but you got to make it in October. And if you look at the trend of the principal going up about $1 each month, you can guess that the March payment is about $644 in principal. So we're moving that one up. The time is taken off the back end of the loan. In other words, we'd only be making 355 payments instead of 360 if we just did this once. And we're not only canceling out all this interest, but we're moving the payments up. So we're paying a little bit more in principal every time going forward. And it's little strategies like this, which are, when you add a whole bunch of these together with all your assets and all your resources, this is how we can use your existing resources to cancel out interest and get out of debt fast. Does anybody have any questions on that? That was a lot of numbers. Does it make sense?
So, so the software that you guys that's affiliated with your company does the calculations, and when you sit with a client, you can actually show them something similar, like illustrate.
Yes, I'm going to show you. I'm going to give you a little bit of a demo of that. Yeah, we can. That's a great question. Yeah, I'm going to show you how the software works real quick. I just want to kind of give you the underlying thing real quick here, and then we'll jump into it. All right. So everybody gets a personal code. By the way, is that the only question on that? That was a good question. I'm going to show you. I'm going to give you a little example of the software.
And about I don't know if I'm jumping ahead, but even with the taking out a loan, borrowing from the bank, is that something you suggesting to do that as well?
I'm just showing you how it works. Okay, you don't have to do this. Let me give you a little history. When the company first rolled this out in 2004, remember they went from a mortgage company to this. You had to have a HELOC to make this work. And so it used the HELOC in this fashion as I'm showing you. And people were getting great results. And, the results were like 20% better than they forecast. And the problem is in 2008, I don't know, how long you been in mortgages, Carolyn? Were you working through 2008? I can't hear it. No, okay.
No, but Edith was.
Edith was. Okay, Edith, what happened in 2008? It was a brutal year, right? 2008, 2009. No one could get a HELOC because of the financial crisis. So they couldn't sell the program anymore because you needed a HELOC and no one could get one. So they rewrote the program, and now you can have either a line of credit or a checking and savings account. So I'll show you, it'll do either one. Okay, you can choose. Most people, 95% of our clients, including Kathy and I, are using a checking and savings account because it's a little bit easier. You can probably get better results with a HELOC, but you don't need it. I just wanted to show you how it would work. Okay, give you the principle. All right, but it won't tell you to get a loan, but you can put the scenario in and say, what if I got a loan, and what if it was this type of loan, and how would that affect everything? So you can put in future scenarios here. I'm going to show you that in a minute. It's pretty cool. Everybody gets personal coach. By the way, is that any more questions on that? That's good. That was a good question.
Yeah, I'm sorry. Can I ask a question?
Yes, you can. Who's this?
This is Edith.
Edith, hit me.
So I'm following you so far with the HELOC. Now, if you do this with a person who's just purchasing a home, unless they put a substantial amount down, they won't necessarily have any equity, or if they did like FHA or something like that, they won't have probably enough equity in their home to be able to do this. So you're talking about if they have other assets, they could, but I'm just thinking that in a lot of cases, people are probably using everything they have to either put down on the home, or they don't have enough equity to have a HELOC right away.
Okay, so just let me be clear. You don't have to have a HELOC.
Right, I understand.
Right, this is only if you had one. And secondly,
Right,
you don't have to have any equity to use the program. Okay,
right.
and you
But
don't have
to have some cash in order, because this was like $3,199. I mean, we've got clients that are going to have that, but you're just saying they got to pull it from somewhere.
In this case, I don't want to confuse you. In this case, you do. But if you don't have a HELOC, it's using discretionary income. It'll probably be more clear when I show you the demo.
Okay.
Okay, that's a good
Okay.
question, though. Very good question. But just know that you don't have to have any equity to do this. You just have to have more coming in every month than going out on average. Okay, so when you get paid, and then when you pay off all your debts and all your living expenses, electricity, phone, and all that, you got to be positive, whether it's $50 or $100. If you're in the hole every month, it won't work because you'll run out of money. We can't help you with income. Well, there's a way that if you become an agent, we can help you with income. But as a client, you need to have positive discretionary income. And that's what it's using every month. It's using whatever is excess that isn't going to expenses or debt or anything that you've already, got in your budget. If you're not doing anything with it, it's going to put it to use on your behalf. And you can decide to do that or not. Anyway, it'll be more clear when I show you the demo. Matter of fact, let's just do that right now. I don't want to waste any more time. Let's just get right into it. All right, so let me, I think I got logged out. All right. So we're going to go into exactly what the program looks like. It has a dashboard which shows you the exact date you're going to be debt-free when everything is paid off. It's going to show you how much interest you're going to save and how long it's going to take. So here we go. All right. Let me, I got to do one thing here. Reset account. So this is your dashboard. These blue windows up here are constantly recalculating. This is like a living, breathing program. This is not a static spreadsheet. If something happens, if life happens, it will adjust, just like a GPS. Something is wrong. Let's try that one more time. Unless they change something. They did some maintenance this morning, so maybe they tweaked something I don't know about. Hang on. It must have tweaked something. All right, no problem. All right, so this is like a a goal for you. Okay, based on if you follow all the steps, which I'm going to show you like a GPS, then these people, this is John and Rebecca Jones, are going to be out of debt on August 15th, 2034, which is 12 years from now. And along the way, they're going to save 138,000. So what we see here is the action plan. Okay, interesting. This is not what I was thinking I'm going to see here. All right, let me try one more time. They tricked me here. Let's try that one. All right, we're going to use this one. All right. So in the action plan, we have all the transactions that they're going to be doing here. And they're just going to follow everything step by step. We're going to come back to this. We're going to focus first on the budget and accounts tabs. Okay. So on their budget tab, we load up whatever their income was. This is John and Rebecca. Okay. And how frequently they get paid makes a difference. John gets paid twice a month, $1,300. Rebecca gets paid twice a month, $1,200. Combined, they're making $5,000 a month. Okay, which is about $60,000 a year. Very modest, right? Their expenses you can itemize if you want, or you can choose not to. So these people, just to show you that we're doing a little bit of both. Their food and dining bill is on average about $400. They have a $150 phone bill and a power bill of $200, and they just decided to put everything else is just kind of a blend of $1,600. Okay, I'm gonna beef up the utilities because I want to show you something here. So we're going to beef up the power to 600. Whoops. Okay, save. Yeah. All right. So they're making $5,000 a month. Their average expenses are $2,750, and when you add their debt, their total monthly expenses is $4,444. Let's look at their debt. Their debts are on this account, on this tab, I should say. They have a car loan for $25,000, a credit card, a $200,000 mortgage at 6%, and a HELOC at $3,500. Okay, a total of $230,000 of debt. And I'm going through this pretty quick. So their income is $5,000. Their expenses, when you add debt, is $4,000. The program is using this discretionary income of $500 a month to wipe out their debt, and it's not touching anything they've already got identified for food, bills, unitemized, or any of their debts. It's only using this $500. They're only making $60,000 a year. They've got $200 and something thousand of debt, including a 30-year mortgage, which they just started, and they're going to pay it all off in less than 12 years. And in doing so, they're going to save $153,000 of interest without changing their lifestyle. That's pretty awesome, right? Now, how does it work? After we load all that stuff up, we're going to spend most of our time on this thing called action plan, which looks like a checkbook. Okay. And all they do is at the, I'd say once a week, when they're doing online banking, they have two screens open. They have one screen of their online banking, and they have this other screen open with this program. And they're just basically crossing off what happened that week. Did John get paid $1,300? He was supposed to get paid $1,300 on the 1st of June. Did he get paid? Yes. So we're going to close that out and we're going to execute it. It's basically crossing that off. Nothing changed up here because that was what was supposed to happen. He was supposed to get paid $1,300 on the 1st. So then we go down to the next thing. Did I pay the mortgage, which is due on the 1st? The HELOC is due on the 1st. All we're doing is crossing off all these things and updating the program with what really happened until you get to these little icons. So this is what the program is acting like a GPS. This is the program telling you what to do. Okay. So we got to the 1st of June. We're going to pay off that mortgage, that HELOC. And the program says, okay, John and Rebecca, based on the income that you have projected, based on the budget you have projected, and based on the debts you have enough discretionary income to make a funds transfer. So on the 1st of June, you're going to take from your savings, you're going to make a big Visa payment of $2,000. And you're also going to make a HELOC payment of $623. So this is the program telling you what to do. And when you do that, it's going to keep you on track for these numbers. That's how, by doing these moves, that's why this isn't 30 years. Normally it would be 30 years because they got a 30-year mortgage. But the program is looking at all their resources and says, okay, based on all the debt you have, the biggest bang for your buck is going to be to start attacking that Visa and that HELOC. And this is what you're going to do. Okay. And notice in July, there's no Visa payment, but there's a HELOC payment. Okay. And then in August, there's no HELOC payment. It's just a regular minimum payment. So it said in August, you don't have enough discretionary income to make a funds transfer. We are moving money from checking to savings so we can take advantage of the interest rate on savings and you don't leave anything in checking, which is usually 0%. So this is going to make us a few pennies, but it's not going to cancel any debt out. So watch what happens here. Everybody with me so far? Stop me if I'm going too fast. Watch what happens if they say, we want to go on a vacation, and that's not in the budget. So we're going to add an action called a vacation, and we're going to pay for it with our Visa. What's a good vacation? Jamaica? Anybody want to go to Jamaica?
Anywhere with some water and beaches.
Yeah, okay. Jamaica, or is you got a better place? Mexico? Huh?
I said Jamaica's fine.
Jamaica's good. All right, we're going to go all the way. We're going to go 10 grand. All right. And we're not going to go in August when it's probably hot. We're going to go in November when it cools off. November 13th. Okay, this isn't in the plan, right? We're adding this, right? And we're going to select a category, travel, vacation. Now, remember these numbers. Right now, we're paying off all these debt in 11.6 years. We're saving 153 grand. Okay. And 115, 2034, but doesn't have the vacation in. Now we're going to save the vacation. And look what happened. It pushed the debt-free date out, what, almost a full year, right? This was 11.6. This was January of 2034, and we were eliminating about 9 grand of savings, I think. So let's look down here. And now we see on November 13th, from the Visa, we're going to go to Jamaica for 10 grand. And that's in the plan now. And that by doing that, we're pushing out our debt-free date a whole year. So you can decide, John and Rebecca, does that make sense? Do you still want to go to Jamaica? You know, it gives you better information to make a financial decision. Now look at this. I want to show you this. There's a button I clicked. I'm bouncing around, called True Cost. So there's an opportunity cost, same thing, true cost equal opportunity cost. But whenever you spend money on something, that's money that came off the table that you could have been doing something else with, like investing. So notice we said the budget for Jamaica is $10,000, but the true cost, can you read that number? It's kind of small. It's 39,000. Why do you think the true cost is 39,000?
Because it took you a year, it pushed back it has to do with the interest, pushing back your year of being debt free.
100%.
Right.
It's like there's 3 things going on here. First of all, there's 10 grand that you took off the table that was already earmarked to pay off the debt you already have. I think that's what you said, right? It was already in the plan. And now that's no longer in the plan. Secondly, you're adding 10 grand of new debt that wasn't there before, right? And third, you're putting it on a Visa. which is going to have interest there on its own. What if we did this? What if we said, well, instead of a Visa, I want to pay for it out of savings? What would that do? And you can see that the true cost is now 19,000. So it's not using the credit card. It's still an extra debt, but now it says until we get the savings up to, the savings account has to get to $10,000 because that's what we're going to use to pay for this, right? And so if you notice, we're not paying off the HELOC big. We're not paying off the Visa big. It's telling you to move money into savings because you don't have $10,000 in savings yet. So before it pays off any debt, it's going to build that savings balance so you get $10,000 because that's what you told it you wanted to do to pay for this Jamaica trip. Does that make sense? So in doing so, you're pushing your debt elimination back because we're not attacking debt. We're only building up savings because you wanted to go on vacation. So now by changing it to savings, it went from 12.6, I think. So it's not as bad as the credit card, right? So now you have two data points to say, do you want to go on vacation to Jamaica or not? You know, and if you do you want to just pay for it out of savings? This is what would happen to your debt. Does that make sense? I'm just going to delete this. Now I want to show you something that's going to be near and dear to your heart. You ready? So this is, what if I want to buy rental property? Okay. Check this out. So what we're going to do here is, you know, they say, well, we're going to be out of debt in 11.7 years. We've always wanted to invest in rental property. So what would that look like? So we're going to add a new account. It's going to be a mortgage. We're going to buy a house and rent it out. Okay. And we're going to call it rental one. Rental one. And it's going to be, I don't know, we're going to go with 250 grand. This is they must live in the Midwest. 4% for 360 months. So the payment is going to be $1193, but let's say the escrow is about 300. So the payment is going to be $1493.54. Principal of interest is $1193 and the escrow is 300. I'm just making some numbers up. You put in the real numbers, and we're going to start in the first of, whoops. Let's see. The statement date is going to, the payment date is going to be December 1 of 2022. Yeah, that's right. And the statement date is there. And let's see if that works. Let's go the 15th, November 15th statement date. Next. And save. All right, so this says you're going to run out of money in 7.3 years. That's because we didn't put in the income for rental income. So we're going to add a new account. We're going to go and do, actually, we're going to add a budget account. We're going to add income. We're going to call it rental one income. So we added the expense, but we didn't add the income. And we're going to say no, and monthly. And what's a reasonable amount? I'm going to go with 1,800. I think that's low. And we're buying it in December. So the first, let's say we go 3 months before we find a tenant. Everybody get that? And let's save that. All right. Now I want everybody to digest this, okay? This is John and Rebecca. They're only making $60,000 a year combined. They already had one mortgage. Now we're going to add another mortgage, right? Rental one. Plus they had, you know, a car loan, a credit card, and a HELOC, and they're going to pay all that off in 15 years. 2 homes. 2 mortgages. Everybody see that? Once we added the income. So the point is they can build equity, they can build wealth with this. They can buy another home. Who do you think they're going to buy from if you showed them this? They're going to definitely talk to you guys. Don't you think? I would.
Absolutely.
Everybody see that? Right? What if you showed this to a bunch of I mean, your whole business is based on partnerships, right? I mean, you work with realtors. You probably work with credit repair guys,
We do that. We offer that service. Yeah.
right?
But we do.
Title guys. So you could get an entire organization that could be driving people to you, so you could show them how to get out of debt. I mean, think about this. We have one mortgage person who is calling prior clients that they already sold to and say, look, we have a new program here that, would you be interested in learning more? Right. And I got some videos I can show you, blah, blah, blah. And a lot of them are taking them up on it because times are rough, right? I mean, we've talked about inflation. We've talked about interest rates going up. It's not fun out there. And so if anything that you can do to help them is going to make you a hero. I think I can speak for Kathy and probably Eric that, helping people get out of debt is incredibly rewarding, and to get paid for it is pretty cool too, And so you are in the ideal seat where you're not only, so you're helping people get into debt, and now you can turn around and help them get out of debt. Now, I say that kind of tongue in cheek. I know you don't think you're actually doing a great service by helping people get homes, no doubt about it. But imagine even better how you could help them pay it off quick. What a cool feeling that would be. So you could go back to prior clients. You could go back to people who didn't qualify, maybe, and introduce them to this. Kathy signed up a guy who does a credit repair, owns a credit repair company, and they're going to call up people that they helped get a loan. So after they repaired their credit, and say, now we can show you how to pay it off. I mean, think of all the possibilities.
Murray, can I jump in real quick?
Yeah, go ahead.
Yeah, I wanted to mention, Rosalind, that Dave Bergio, I think you had met him. That was with Trifecta on Thursday night. So that's who is a partner with us for the credit repair too. So we have kind of that connection with him as well. So
Awesome. Yeah, exactly. Okay, great.
Does that make sense?
Totally.
So the real winner here is the client. Okay. And but this is something for you guys too. So the average commission is between 900 and 1500. Okay. So this is something, and there's a lot of ways we can play this. You can learn how to do what I'm doing here and do it yourself, or you can just refer people to Kathy and myself, and soon Alexita when she gets on board, and we can do the presentation for you, and we split it. Okay, so what we don't want you to do is lose focus of helping the customer by getting them a mortgage. Just know that, right? We don't want to send you down some sidetrack that's going to take up your time. I know you're probably pretty busy selling mortgages, right? So we don't want to get you off that path. But I'd like to demonstrate here, though, that we can get you more business and more money, both directly from this program and from getting more business without changing what you're doing too much. You could just ask a few questions and then say, well, let me introduce you to my partner, and we can show you how to get rid of this debt. Let me show you. This is what we run this report for everybody. We run an analysis for everybody, every client, before they buy it. Can you see this? Oh, sorry, it's bouncing around. Get this blue thing out of here. Can you see that?
Yes.
Okay. Sorry about this blue thing. Anyway, this is my actual report from a little over 2 years ago. All right. So before I bought it, we input all my income, we input all my debt, and we input all my expenses at a high level. And we estimate, and the program generated this report. So I had 167,000 of a mortgage. And remember, I've been here 25 years. And I had a car loan for 16,000. So this is not just for mortgages, right? Student debt is a big one. I mean, you may have clients, young couples that are burdened with student debt, right? Whatever, any kind of debt, this works. And the program understands the different kinds of debt, and it will wipe out debt as fast as mathematically possible. But anyway, I digress. I owed $184,000, and it was costing me $2,200 a month to service that debt, which I call debt prison, right? Until I pay the bank off, I can't do anything with that $2,000 every month. It's tied up, right? And in the month of April, it's costing me $600 in interest alone, which is like not helping me at all. And that's just what I owe. The program doesn't help with what you owe. The program can't help me pay off what I owe, but it can help me pay the interest, reduce the interest I'm paying. So I owed 184,000, but if I pay the normal amortization schedule, it's actually going to cost me 324. My highlighting thing isn't working too good, sorry. Anyway, 324, that's 140,000 of interest I would have had to pay if I stuck to what we call the bank's plan. But when we ran the analysis, and the program is called the Money Max account, we're estimating that I'm going to limit my interest to 29,000, which is going to save me $110,000 of interest without changing my lifestyle. I mean, can you imagine that? That's freaking huge. But I'm a lot older than you guys, so time is more important than money. So I'm going to go from 30 years to 7 to pay all that off without changing my lifestyle, saving 23 years. And for the 7 years that I'm going to be paying debt off, I'm going to save an average of $1,300 a month versus if I had to follow the normal amortization schedule and the other debts I have, in this case, the car loan. But here's the real juicy part. You ready? Okay, check this out. I want you to envision this and how this could help your clients. So this is a very simple amortization schedule by year. The red column is how much debt I have now and how much I would have at the end of each year if I just follow the normal amortization schedule. So it's going to take me 30 years to pay that off. I'm not sure I'm even going to be around in 2050. This column here is if I buy the program. In year 7, I'm projected to be debt-free. By the way, I'm going to beat this, but this is what it was projected. And that means after year 7, this amount of money every month gets out of the slavery of debt, right? Out of debt jail. I can do whatever I want with it, right? I'm not stuck to making some bank payment. So what if I invested, I'm going to sneeze here in a minute. Excuse me. Sorry about that. Hang on a minute. I lose my voice when I sneeze. That's pretty weird. Sorry. So in this case, we're going to do a very conservative. That's weird. Sorry about that. We're going to put this $2,000, which I was paying every month to debt. We're going to put it in a 1% savings account. Now you'd have to be an idiot to do that because you're losing money with inflation being, whatever it is, 8%. But just to show you what's possible, if I put that every month into a bank account, by year 10, instead of owing 131 grand, I'd have 93 grand in the bank. That's a pretty huge swing, right? Year 15, instead of owing 106, I'd have 254. Fast forward down to here, instead of getting out of debt, I'd have almost 800 grand. Now that is at 1%. What if I invested this in, say, something like real estate? Depending on what you're doing with real estate, it could be 10, 12%. This number would be in the millions, right? If you invested this instead of putting in a 1%, it would be much higher. I'm just showing you a very conservative estimate. And if they're going to invest in real estate, who do you think they're going to come talk to get a mortgage? I'm going to say Rosalind,
Yes.
right? And now this is going to somewhat answer your question earlier. Even at year 3, they're still owing 110 grand, but it's a lot less than 158 grand. So there's a little bit of equity there where they could get a HELOC if they wanted to. Let me go back to this real quick. I know we're over on our hour, so I appreciate you guys hanging around. But the way this is set up now is using what we call the checking and savings method, which is what Kathy and I are doing. And it's using the savings account as what we call the offset account. But if you wanted to use a HELOC, like I did in that that little example of the HELOC, let's see if this is going to work. So if you had a HELOC, first of all, you have to get a HELOC. So you could put in here, what if I wanted to get a HELOC? And then you could click the button I just clicked and look at this. So this is using what's called the HELOC method. What does that mean? You're using the HELOC like a checkbook. Okay, so John is putting his income into the HELOC, and then we're writing a check from the HELOC to pay the Visa, to pay the mortgage, to pay the phone, pay the mortgage again. So we're using the HELOC sort of like we did in that little graphic that I showed you, the 3199. So what we're doing here is we're telling the program we want to use, quote, the HELOC method. What would that do for me? So you could compare this number, I'm saving 165,000, with the other way. Let's go back to the other way, which was preferences. Whoops, no. I want. So 165 versus, we're looking up here now. Now we're going. So this says the checking and savings is going to save them more. But you have more information to make a better decision. I don't know if everybody followed what I just did. So now I just switched it back. It's using a checkbook, basically like a checkbook. And you're moving money in and out of your savings account to pay off the debt. 90% of people are doing it like this, like myself and Kathy. Go ahead. Who had
I
a
have a
question?
question.
Yeah.
This software, what's the word I want to say? Is it like automated, or does it do like the client have to, yeah.
Does it connect with your accounts?
Yes.
Okay. Let me answer that a couple of ways. First of all, you get free upgrades. It's not like Verizon where when your phone is out of, this program is for life, not just for the debt you have now. But like I showed you in that investment thing, or going to Jamaica, you know, you're going to probably get another car in your life. You're probably going to buy another home, you know, maybe, or, you know, maybe you have grandkids that you want to put through college or something, you know, so you're going to have more debt. This program is for life. It's not just for the current debt you have. You can keep putting in future stuff. To answer your question, you can connect. There's a program called Auto Connect, which is a third-party software that connects, just like Quicken and Mint and some of the other programs. It will bring over your transactions. I'll let Kathy talk about that. That's an option. That's the only extra cost. If you decide to do that, it's like, I don't know, 14 bucks a month to do that. If you like to itemize, it's definitely a time saver. I don't have that much going on because I'm doing what we call this I'm not itemizing. So I've got a lot of slop in here, and I just balance this out at the end of the month, and I don't keep track of all the details. So for me, I don't need to do the auto connect, but yes, you can set up an auto connect where it'll bring all your transactions over. Kathy, you want to talk about your experience with that?
Yeah, I use Account Connect, and it definitely, if you like to do that itemization with every transaction. So I've like for me, I have multiple credit cards and the bank accounts and such for my transactions. So every transaction gets pulled over to keep track, especially if you're keeping track for business expenses, because it's good with if you have your marketing expenses, your any kind of operating for business or your mileage and such or gas. And so for me, I like it just because I like to categorize everything, and it gives reports out later, say for your yearly taxes, then you print a report off to keep track that you can give to whoever does your taxes for at the end of the year or next year. So that's why I like it, just because then it pulls every transaction and you're just kind of executing every single item that you're confirming, yes, this was pulled out or whatever from your credit card or your bank account. So it's definitely if you want specific categorizing each transaction, that's definitely nicer for me, because I like keeping track of everything. But it depends what your preference is.
I was just thinking for business owners, because a lot of people,
Yes.
they're so busy and they want,
Yeah. Yeah.
That was the draw for me, because it simplified everything, that everything connected. I can see the transactions and you just execute everything, spending 20 minutes every week or two. And that was my draw, especially for just to simplify my life, to plug everything in and you see every transaction that comes through, and I don't need to try and figure anything out to pay off my
That's
debt.
a big, for a lot of business owners, to me, that would be very valuable.
Yeah.
Yeah.
I'd like to have Kathy tell her little story real quick. So when we first ran her analysis, okay, so this thing here, we ran this for Kathy. She didn't have a mortgage. Okay, so it's not just for people with mortgages. She had other things, and when we first ran this, help me out, Kathy. It was you went from what to what in years?
I think I was about 25 years to I think it was about 8 years.
8
for the
years.
payoff.
So that was about 17 years savings, right?
Correct.
And then Kathy started using the program. Go
I
ahead.
started using, and I adjusted what I was doing because I was looking at what my payoff date, what I was saving, and I adjusted quite a number of different things. So my main change was I stopped putting money aside for savings and investments because I wanted to kind of put more focus into paying off the debt, which eliminated, I think I went down to from about 8 years down to about 5, I believe it was, at the time. So then I put more to my debt, less on savings. And when you're looking at it, you can take a look at the what if scenarios to see, okay, what if I change this, or what if I eliminate the coffee shop at once or twice a week? How much would I save, and how much would it affect my debt? So that's what I looked at, doing a couple different scenarios with my savings, just reducing or eliminating. So, and I've since started back up with my savings, but you can make those decisions, be more informed by doing those what if scenarios in the program to see, like, how will this help me or hurt, just like we do with the vacation, but it's also what you currently have. So it's it definitely makes you more informed of the decisions that you make financially. And I'll kind of backtrack a little bit, because when I started, I have student loans and credit cards, and I was almost maxed out my credit cards, and that's what really drew for me, as well as the income potential, so that needing more income, paying off the debt, and just having that, knowing exactly what I should be doing, because with having a busy life, it's just makes it nicer that I don't need to figure it out. The program tells me exactly what I need to do. So that's a little bit of my story.
Pretty cool. So thanks,
Mm.
Kathy. Yeah, we got a lot of cool stories. I got a story of a guy who his phone bill was 150. He went down to the next lower plan because he wasn't using all the minutes. He changed this to 120 and he saved like 6 months off his debt. So I said, yeah, let's do that. Very simple little things. Kathy could see the interest she's saving, right? And she did a what if scenario and saw what the difference in interest savings was versus what her 401k was going to earn. And she could have raw numbers to make a decision, right? Does that make sense? Everybody get that? That's pretty cool.
Mm.
So stop me if you have more questions, but let me just show you this.
Are you able to see the screen? Because I got my hand up. I didn't want to interrupt you.
Oh, no, I can't see. Go ahead. I'm sorry. Go ahead.
So I just wanted to know, number one, does the client also get this software? And I guess we can talk later about the cost for them to get it. Or is that something that we do as a service to them, right? We
No,
keep them on target and
no,
let them know what they need to do.
no, they buy their own. They buy their own and it's cloud-based, but they buy their own. You don't have to manage it for them. When we help them get it set up and we answer their questions, and the best way to sell this is if you get it, but I don't want to, it's not required to get this to sell it. Just so you know, I'm not trying to sell it to you guys, but I would like you to see the client experience, if we could go through that.
Okay,
But
I'm sorry, could I just ask one more question before I forget?
yeah,
When
yeah,
you're plugging in the payments, right?
yeah.
Are you able to also plug in if they make, do you ever encourage, because we actually have one of our lenders who actually does help people to figure out how to pay their mortgage sooner. And back in the day when I worked at a finance company to compete with the banks, I helped my clients to see how to make their payment, make one extra payment a month, or do 2 monthly payments
Mm-hmm.
to cut into the interest. Does this have the capability of doing that as well?
Certainly that stuff still works, no doubt about it. And I applaud you for doing that. So that's great. This is actually going to be more efficient because it's using math to, it's got the math baked into it. That's going to wipe out debt as fast as the interest as possible. So for example, this is not a good one because it's not paying off the mortgage. This particular example, it looked at the Visa and HELOC and said, of all the debts you have, these two are going to be the biggest bang for your buck. So we're going to go attack that and just make the minimum mortgage payment. So in this example is a bad example for what you're asking, but when it comes to paying off the mortgage, it's going to tell you specifically the day and amount of additional payment you're going to make to that mortgage. Let me just show you something real quick here. Maybe this will help. So right
Well,
now,
while you're finding it though, what you could maybe do is if they want to make an extra, because we do have clients who pay extra,
yeah,
right, on their
yep,
mortgages. We just closed one.
yep,
She was paying extra. So if you plug that number in,
yeah, you could
then
execute, you could put a bigger number here in, yeah, yep,
exactly,
yep, you could do
and it
that.
would show how fast it would get paid off.
100%, yes, 100%. Let me
Murray, can I interject a little?
go ahead,
When I
Eric,
was,
my man.
yeah, I'm an engineer and I studied math, and they just started coming out with computers when I started college, and they didn't even have Excel yet. They had Lotus and Fortran and that kind of stuff, and we had access to it to being in the military. So but you had to know the math. You had to plug in the equations, and even in '89 when Excel came out, you could build a nice spreadsheet, but you had to know the math to do it.
Right.
And I could do that too. I could put you two payments ahead on your mortgage. I did this for people in the service. And that way, when you rotated in 4 years, you'd have 4 years of equity. You didn't walk away empty handed. You had down payment for your next home at your next duty station. But the way this thing does it, it thinks of everything. I mean, if you're going to try and do this yourself, yeah, adding always paying more on principal helps. It knocks it right down. But this one, it thinks of stuff you'll never think of. And every scenario I run through it, and we put actually Murray and Mike himself did like the worst case scenario guy, and he's in great shape right now. But what happens with this program, it gets you every dime, and it's proprietary software, and it's designed to only do this. It doesn't have other uses. It helps remove that. So every scenario I've done with it, you're always, with whatever you try other than this, you're going to leave 30, 40 grand on the table. If you're looking at, between $200,000 and $300,000 debt over a 30-year mess, like most folks are in. So this is where it's at, and that's why you got to pay for it. It's worth every dime. I would gladly say it cost me $4 grand to buy this program. Hey, I'm saving 100 grand. It's the same as when you're doing, the revolving credit with your signature loan, to pay in debts. It's the same deal. You're paying $26 to get $4 grand. It's just a no-brainer. So I love this thing, man.
I've not seen anything like this, but I will tell you, if you got people that we talk to who are loving the idea of paying their debts off sooner. But if we are telling them, look, if you've got that extra money and you add an extra 300 or 400, and then you add that on the very end, and then they can see how quick. Well, I mean, we had a client who just asked about this, Rosalind. Remember, I forget who it was, but how quickly, it could get paid off. I'm just saying you could add that number in to their payment.
You could, but let me, if I may say so, the program is already optimizing it. So it's like you're fighting the computer. That might not be the best way to do it. I mean, you could do it. Let me just show you this. So right now, there's a setting here called preferences. By the way, great questions though. Don't get me wrong. I mean,
I'm just saying if they got extra money, okay.
This is only using extra money. See, it's that extra money is a floating bucket. Remember I said it was $555, I think, in the example. They had that much discretionary income. That's quote extra money, right? That's what it's using, right? Does that make sense? So it's using that extra money. Now you could force it to pay the 300 of that every month against the mortgage. You could. Now, check this out. This may kind of address what you're saying. So there's a thing called focus settings. 95% of people are going to leave it on automatic. What does that mean? These people have multiple debts. If you only had a mortgage, what you're saying is more valid than, but if you have multiple debts, like most people have, paying that extra mortgage may or may not be the most optimum, right? So the program is thinking for that. So if you leave it on automatic, it's looking at all of your debts and figuring out which debt is going to give you the most bang for your buck. So that's kind of like most people leave it there because that's the strength of the program. However, if there's some reason why you wanted to pay off a different loan, other than financial, maybe there's some other reason that the program is not going to be able to, let's say the mortgage. Remember what we just looked at before I came to the screen, they were attacking the HELOC and Visa. So let's say I want to pay off that mortgage first. Now look at this 9-1, 173 grand. If we put the priority on the mortgage, it's going to prioritize the mortgage. And this dropped 3 grand. Did you see that? It went from 173 to 170. And I think it was a month here. Eric, what are you going to say?
It's not as efficient.
It's not as efficient. No. Yeah, I mean, you can do that.
That number 170 dropped, but the time didn't drop.
This didn't drop because it's rounding, but this dropped a month. It was 9-1, I think. Here, let's go back on. 9-1.
9-1. Okay.
Yeah. See, so who was that asking that question? Was that Edith?
Yeah.
Yeah. Does that make sense, Edith?
Yeah, because I had somebody who was going to be retiring and their income was going to change.
Yep.
And so what their situation was at this time and what it was going to be in about 9 months was going to be completely, this was a friend of mine that lives here.
Yeah.
And so this is good because it tells you right now based on your income right now. But I was just wondering if something changed, you can add another.
Oh, you can edit. That's the strength of this. Edith, great question. Look at this. So when we signed this guy up, these are fake people, by the way. John was making $1,300 twice a month, right? So we go 6, and this is all projected based on him continuing to make that.
Right.
Right. But let's say 6 months from now, I'm going to make something up. That's going to drop. So remember these numbers. Okay. Remember they have, I think, is this the one that has the 2 mortgages? No, I took that out, right? 1, Yeah, this is just 230 grand of debt, of which 200 of it is the mortgage. All right, so watch this. I know I'm bouncing around. Let's say John has, he's no longer making this. So now he's going to make $500 on Social Security. No, let's go with 1,000. All right, and he's only going to get paid once a month now, starting now, right? So they're going to be out of money in 11 years. So they need to come up with something else. But at least it tells you that,
Mhm.
right? So the point of this whole illustration, look at this. Maybe if he gets paid twice a month, 500, maybe it's going to give us a different answer. 2 different days. Oh, it's giving me a hard time here. All right, that didn't work. All right, bottom line is it tells you in advance what's going to happen. And so
Mhm.
you can plan for that. Yes, things do change. So look, discretionary income has dropped to negative. That's why they're going to be out of money. Remember I said you had to have positive. It was 500 positive. Now it's 600 negative. So they're going to run out of money. So they either got to cut back expenses or they got to make more income, or else they're not going to pay off this debt.
I like this for so many different reasons,
Yeah.
and for investing, it's a lot. For like you said, I was just meeting with a client. He's doing really well, doing really well, but we need to slow down his spending, and he needs to start putting money aside. And he got up anyway. I told him in 6 months we was going to look at his to refinance, but anyway, we're probably going to do something like this with him because
And
anyway,
Rosalind, you can
yeah,
show them where they're going to be at if they keep what they're doing, right?
exactly.
There you go.
Versus if you do this, this is where you'll be.
Yep.
I think you're right, Rosalind, on that.
Yep. Can I share this with you? My number one client is a guy in the Navy. He's 19 years. He's going to get out next year. And he invests in real estate while he's in the Navy, which is pretty cool. He buys, homes and rents them out, and they're all over the country. And he's got it set up where he's got other people managing it and all this. Pretty cool. He's actually got masterminds going so other military people can learn how to do that, which is very awesome. His goal is when he gets out of the Navy next year that he doesn't want to work for anybody again. He's just going to live off investing, right? So get this. I don't know how many properties he has. I'm going to say he has 8 now, but he had forecasts that he wants to buy a new one every 4 years so he can build up his portfolio, right? And build up his income. And then we ran the numbers for him, and he's going to basically use the program to pay off the existing mortgages faster. And he accelerated. You know how I showed, in the future they wanted to buy a rental property? We put in him, and we were able to prove that he could pay for a property every 2 years instead of every 4 years by using this program, because the program would help pay off those new properties. Does that make sense?
Yes.
So he's like my number one client. And, imagine getting somebody like that as a client.
Well, we
Somebody
deal
wants
with
to buy
people like
multiple
that, right,
properties.
Rosalind? We got
Yeah,
some
this is.
people like that.
Oh yeah, absolutely. This is this is a no-brainer. I have another Zoom meeting actually is starting
Right
at
now,
8,
huh?
but yeah, but this is really good information. So what is the next step?
Let me give you real quick. So you get paid 500 to 2,000 for each client you talk to and sign up. That's the amount. I'm going to send you this, okay? But the cost to be an agent is usually $199 for that's it, okay? Which is nothing. You don't need to be licensed. But we're running a sale this month, and I'm not trying to. This sounds kind of salesy, but I'm not. Just coincidentally, it's $79 this month. what I would recommend we do, next steps, is sign you up as an agent, and based on the relationships you already have, you would be an agent under Alexita, right? Because she's the one who brought you in. And likewise, if you bring anybody in, and if you decide to buy the program for yourself, you can write it off as a tax write-off because you are an agent. But what I recommend we do is at some point sign you up as an agent. And then I think we should run a free elimination debt analysis for each one of you. Not, I mean, yeah, it'd be great if we could save you a lot of money, but I also want you to experience what a client would go through. Right? And in generating this report and getting the quote, the whole thing. And so then when you refer somebody to us to do the presentation to them, I would like you to join us on the call, but you don't have to. It's up to you. I can tell you that if somebody refers somebody to me and they're on the call with that client, I do all the talking pretty much. Kathy does all the talking. It makes a big difference if you're on the call with them because it just gives them more confidence. So we have a much higher success rate, but you don't have to be on the call. Bottom line is, what I think the next step would be is to book a call with me to run your analysis. And I'm going to put this chat in the chat. This is my calendar. I don't know if you ever use a calendar program. So make a note of this. We'll run an analysis for you, see what you can see, you can experience it from a client. Hey, if we could save all your debt in 5 to 10 years, you might be interested in buying the program yourself. And you don't have to get it, but I can tell you that if you do get it, it's a lot easier to sell it, but it's not necessary. We have people who who don't own it. But anyway, does that make sense?
It makes a lot of sense. Let me ask you one more question. Do you just sign up individuals, or can you sign companies up, or is it the
It's how you
individual?
want to do it. Good question. So Dave Bergio, the credit repair guy, signed up his company. I signed up me, but I use my company name, but I'm a solo guy. So it depends on how you want to do it. You can do it either way. You can sign up as you, and then sign up, and then everybody can sign up under Alexita individually. Or you can sign up as marketing mortgage formula, and we'd have to figure out who's going to do what with that, but you could do that. So it's a matter of choice. I don't know if we answered that question, but there's a lot of flexibility. You can do however you want to run your own business.
You did. Awesome.
Yeah.
Sounds good. So I'm gonna have to jump off. You guys want to stay on?
Okay.
I gotta jump off with this.
Nice to meet you, Rosalind. Everybody else stay on for just a second.
Yeah. Thank you. And
Okay,
I'll catch up with you later. And so,
okay.
thank you guys.
Bye, Rosalind.
Good luck.
Thank you so much. Appreciate it. Let me leave that.
Yep. Have a good night. Good luck with your call.
Thank you.
All right. So, Alexita is so new, she doesn't even know how to sign you up as an agent. So Kathy will have to help her. But that's what I like about.
Check, yeah. I'll go through a little bit with Alexita, and then Rosalind and Edith.
Yeah.
Would you be interested then as well?
Yeah, I think so. And I think probably Alexita would probably sign the company up, and then everybody else could possibly come under the company. I don't know. Lorenzo and Rosalind will probably have to work that out. So
Explain to us, if you don't mind. Is Rosalind like the owner of the company?
Rosalind and Lorenzo basically put that company together.
Oh,
I
okay.
worked with them before, and so we are part of the company, Soul and I.
Okay.
So we work for Mortgage Formula. So the entity itself, yeah, that's Rosalind and Lorenzo are the brokers.
Okay, that's their brokers. That makes sense. All right. Well, they could do it either way. Rosalind could sign up as an agent, and then she could put everybody else under her. And then she would or she could sign up the company.
I think you're frozen, Marie.
Oh, am I frozen? Can you hear me now? Let me turn off my video.
Yeah, I think I think Lorenzo and Rosalind would probably work together and work that out.
Yeah.
And then let us know.
Okay. But either way, I think we should run everybody's analysis for them just to see.
Yeah.
That, you know, just so you can experience it, you can have confidence in what it does, and you have a feel for what we're going to be showing people. I mean, it's a lot of what you just saw. But anyway,
Yes.
the big thing for me is the Ernst & Young thing was a big thing that got my attention. I don't know if you know Ernst & Young, but they, you know what, ever work with an accountant? They're very conservative, right?
Absolutely.
So they wouldn't, I never knew they even had that award. So that was a big deal for me. And when I talk to accountants, they get that impresses them. So I always like to say that.
Yeah,
So,
it speaks for itself.
yeah. Yeah. So really, again, we're trying to help you. I want you to let your imagination run about how you could use this to help people you've already, not only people in the future, but people you've already talked to.
Yeah.
You know, we can go back and reopen files or conversations with past people. We can help with any kind of debt, but
Mhm.
the fact is, without, you know, and this is common knowledge, that mortgages are the biggest burden for people, debt wise. And this is not an insult to you guys, just the fact of the, you know, again, the volume of money and how the amount of interest that's available. So in other words, there's a lot of meat on the bone
Right.
that this program can save because there's so much interest in there, you know? So you're in a perfect spot to leverage the program to help your clients and yourself,
I agree.
you know, and when you're introducing it to your clients, we have a full training. We have a lot of training. So you can, if you'd like to, which we recommend, is learn how to do what I'm doing and just be able to talk about it. And, you know, the fact that you're in the mortgage industry gives you a lot more credibility than me.
Yeah, I've been in it about 30 years, and I
Oh,
did that consolidation. I did um like when both times when the industry hit, I did loss mitigation.
wow.
I did all that stuff, and including credit restoration. So
So you know your way around. So you're going to have this is going to be, you know, people are going to listen to you. You know what I mean? I mean, you've been there
yeah.
and you know both sides of the fence. So you are going to be extremely well suited to do this should you choose to do it.
Oh, I will choose to do it. I think that this is something that is missing from my portfolio, because this now you actually can put people's financial situation right in their face so they
Ooh,
can see it.
ooh,
So they have to really look at it, the numbers. And
mm,
so you instead of you trying to explain it to them, now they can see it for themselves. And with the way that the economy is going, this is a
wow.
perfect time to have something like this.
I think you're ready to sell tomorrow. Listen to that. What do you
Yeah.
think? Eric, that was a pretty good, that last 30 seconds there, Edith, man.
Oh,
You
yeah, well,
rocked
look
it.
at it this way, Edith. Once you become an expert in presenting this to people and running their numbers, which it doesn't take much, because I'm really interested and I learned it in an hour or so. You can too, because you're interested
Yeah.
in it. It's your business.
Well, I
You get about
started
700. Yeah, you get about 700 people. That's $1 million to you. Think about that.
Oh, we can easily do that. So
Yeah,
the
because
thing
you
is,
probably have 10,000 customers for 30
we got a
years.
lot of customers
Yeah.
and through the years. And look, I started out working with a finance company selling interest rates at 11.99 at household finance when the banks were at 7%. But you know what? I use my little handy dandy calculator and show people how to amortize their payments
Mm-hmm.
and have it paid off. I think it was like 21 years at 11.99 interest rate, and pay it off before they paid off. So it's what they can see. You can
Mm-hmm.
you can show it to them. So I think that our team will be interested. The person who really is going to want to see this is Lorenzo.
Okay.
So, but I know he was in the meeting tonight. So
Mm.
um, we'll have to definitely, when we talk to him, because he's the one in our team who deals with all the Spanish speaking clients.
Oh, wow. That'd be
Okay.
great. Yeah.
So he does insurance, he does the mortgage,
Mm,
he helps people with their credit, he does all of that. So he and I both have been working together for probably about 20 years.
nice.
Yeah. So
Well, I'll give him this recording, but I'd be glad to do the whole thing again for Lorenzo if he wants.
yeah. And
Uh,
Rosalind is the one, she's the face of the company from the standpoint that when we have clients come in, she deals with their numbers, she gets them approved, she does. So I'm the processor. So
mhm.
I'm kind of more in the background.
Yeah,
And I collect their documents and so forth, but I'll be taking my test here soon to be a loan officer.
beautiful.
So out here in Arizona. And
Mhm.
I tell you what, the financial situation isn't looking too good here because everything is going up. So to be able to project for people,
Yeah,
where they will be if they continue in the situation that they're in is powerful when you can show it to them right in their face,
yeah, yeah. That's
So
great.
yeah, you don't have to sell me. I got it. I got
That's
it.
a breath of
So
fresh air for me, Edith. This is great.
well, we appreciate your time. What we'll do is Rosalind, I'm sure is gonna work with Lorenzo and see if we can get Lorenzo on, but he'll probably just see the recording too, but I'm sure he'll have some questions. So
Yeah, I'll send the
'cause-
recording and you guys make the call whether you want to meet again. Coordinate with Kathy. Okay, Kathy has my calendar. She's going to be, she's my top partner and she's the one who she knows Alexita. So,
well, here's my other question. Do you have it in Spanish?
so we have a presentation in Spanish. The actual program is not in Spanish yet. In other words, can you see my screen still?
I think we should be okay with that because their applications are in English too. So
Yeah. I mean, we do have a PowerPoint presentation. We have 2 PowerPoint presentations that are in Spanish, and I can send them to Lorenzo or whatever, and I can introduce you to Edgar, who is a company leader. He's the guy who actually did the translation for us, right? And he's Hispanic. He is a tremendous guy. He's a real estate investor, and he was making 6 figures with a day job, investing in real estate and selling this. And he got laid off with his 6-figure job. And he's using his real estate investments and this, and he's still going to pay off everything real early because the program is helping him pay it off. And he's a great story, but he also speaks Spanish is my whole point. I wish we had Spanish in the actual software, but we don't. We
I
do
think
have
we'll
some
be
training
okay.
in it. Yeah.
Yeah, I think we'll be okay because the numbers. I mean, Lorenzo is a powerhouse in the Hispanic community. His office is located on a corner of like Broad Street downtown, and everybody comes to him for everything. So
That's a very underserved market. I mean, I think
yeah,
we don't have enough people in our company that do the Spanish market. So I think this is going to be a bright future for him.
yeah, I think he will probably explode this product. So
Yeah. What when you say on the corner, are you talking which corner of what town?
he's in Hazleton,
That's Pennsylvania.
Pennsylvania,
Yeah. Okay.
near the
All right.
Poconos. Near the
Okay.
Poconos.
Isn't that near you, Kathy?
Oh,
Kathy,
Yes.
you're near
Yeah,
Hazleton, right?
it's fairly close.
Yeah. Okay. Cool.
see, we would do seminars about this, so that would be kind of nice.
That would be great. If you want me to start, I can do seminars, and then we could lead, and then Lorenzo could take over,
Yeah.
or whatever. Yeah. And, we could bring Edgar in. He's not necessarily with my team, but he's a genuinely nice guy who could help with some tips.
Yeah, and if you could reach out to the Hispanic gentleman as well for Lorenzo, that would be because they come into Lorenzo's office for everything, literally.
That's understandable, right? I mean, you gotta be able to relate to somebody that's in your,
Mhm.
culture and stuff. So
Mhm.
good. That's great.
Yeah.
All right.
Well,
Kathy,
thank you so much.
wait, Kathy, you got any final words? I'm going to let.
Oh, no, this was great and glad we could, hope we can reach out, Edith, if you have any further questions or want to schedule the next meeting, that'd be, do you have my information? I should have put my email and phone number in if you want to reach out to me.
Yeah, put it in the
Here,
chat.
let me do this. if you want to reach all of us at one time,
Okay.
or let me see which one.
Are you
Um,
guys on LinkedIn?
I think so. Hold on one second. Bear with me here, please, for just one moment.
Sure. While you're doing that, is Soul still on?
Yes, she is. Yes,
Yep, I think she's there. Soul, if you have any questions,
Yes, I am. No,
you
not
hanging in there?
more.
Okay,
Thank you so
good.
much for the presentation.
You're welcome. You're welcome.
Yeah.
There we go. Info, you got that, Kathy?
Yep. Getting it.
if you email us there, we all get that email.
Awesome.
Okay.
We all respond to that. So myself, Rosalind, Lorenzo, yeah,
Okay. great.
If
Alexia, we're all in that email.
Kathy, if you can get everybody to sign up as an agent before September 1st, they can
Yep.
invite everybody to that presentation we're doing.
Oh, yeah.
Okay, so
And I
that'll
think I
be
told Rosalind about that.
Alex Zeta knows about it, but yeah. So
Yeah.
that'll be something you can work on with them, okay? I'm gonna send you some
Okay.
information on it tonight.
Let us know.
Yeah, it's a good way to leverage your connections. So, all right.
All right.
Anything
Awesome.
else before we wrap it up?
No,
I'll
I
send-
think I'm good.
I'll send you guys a link to this, okay? The recording.
Absolutely. That sounds wonderful. Thank you all so much. We appreciate you.
Nice to meet you.
explaining
Thanks
all
for your
of that.
time. Yeah, thanks
All
for
right.
Yeah.
Eric. Thanks a lot for coming and your input. Have a good night.
Good night.
Good night, guys.
Good night, everyone.